We're half an hour away from the open in Hong Kong, Shenzhen and Shanghai. You're watching the China Show. I'm Annabelle Droulers with David Ingles.
Good morning. Let's get to your top stories this Monday morning. Chinese regulators are pledging to step up efforts to stabilize both housing and also the equity markets after top leaders call for greater stimulus. We have a flurry of economic numbers coming out this morning.
Well, Asian stocks, they're trading in a tight range ahead of that data dump, with investors also bracing for a busy week of central bank decisions, including a potentially hawkish cut from the Fed.
And I'm Sherrian in Seoul as investors respond to the impeachment of President Yoon by boosting Korean stocks and the won.
Well, this is the last full trading week for a lot of markets, but you take a look at the event risk that we've got ahead and you definitely wouldn't think we're getting this close into the holiday season. Lots of different things that investors are going to be watching over the coming days. So just kicking off with what we got with central bank decisions in Southeast Asia, from the Philippines, Indonesia, Thailand, North Asia. Of course, we've got the BOJ. Are we going to see that hike? And of course, the Fed smack bang in the week as well, looking at potentially that hawkish cut you were just hearing there, but pretty much 25 basis points is baked in. Ahead of that, you've got investors that are pushing stocks just a little bit high here to start the week, but really some of the things that are standing out to us as well when it does come to event risk is what's happening in Korea this morning, because you are seeing markets here that are moving higher. We've seen strength coming back into the local currency as well, the Korean won. And this is an investors really digest what happened over the weekend. We had that second impeachment vote and lawmakers this time voting to remove President Yoon from office. Now Han is standing in his place, and you do have the Constitutional Court 180 days to ratify that decision. More details on that ahead, but just suffice to say markets are reacting positively to the news. What else is the big focus? Of course, what I mentioned is China this week. Do have a host of economic data that's going to be coming out. Take a look at what we had, because the end of the week we had credit data coming through on Friday. Saturday we had the FDI figures, and then as well a host of different policymakers essentially trying to offer more efforts around stabilization, shoring up the economy, pledging further supportive measures essentially ahead of the open today. You do see these just futures looking fairly steady. Again, we've got that big data dump just coming up. But just to note as well, that credit figures that came through, another signal to us that the amount of stimulus we've had so far from policymakers has not been enough to lift demand from households, from credit. Data still remains weak. In fact, new loan growth falling for a 13th straight month. And then you add to that as well, Dave, what I said on Saturday, we had the FDI figures coming through, and inbound investment, again, it continues to contract.
Yeah, and to your point there, amidst the data that's to be fair and frank, really, we weren't expecting any big turns. Still, high frequency suggests though that things are improving on the margin, and I mean 1, 2, 3, 4, 5, and 6 different pieces of promises here coming out of regulators that they'll do more on the housing market, on the stock market, on bank lending, on keeping the FX market stable, among the many things, of course, that they're coming out with this week. So in terms of news flow, it doesn't feel like the holidays, really, when you go into this trading week ahead. And top of all that, will, of course, to Belle's point, be dissecting all the activity numbers coming through. Home prices are out at the bottom of this hour, and then this time in the next hour as well will be all the activity numbers coming through. CGB rally. What do we do with that information here? The PBOC also coming in basically saying that they'll be stepping up their sovereign bond trading operations, as according to CCTV. More on that in a moment. Just keep in mind, as far as markets go, I'll make this very, very simple and short. We're coming off one of the worst days in equity markets in weeks on Friday, so quite a substantial drop. The 50-day should be very much in focus, particularly in the onshore markets where we closed below that key benchmark or that key psychological level as far as that's concerned. So we'll see what happens with that. As far as the estimates for the activity numbers coming through, so these are November numbers. We're comparing the estimates, at least at this point in time, with what we got in the previous month. Slight uptick in most, if not all. But I think central here will be the home prices, which will be coming out, of course, Belle, at the bottom of this hour.
Yeah, and actually on that point as well, as you said, we've been hearing from a lot of different regulators over the weekend, but one of those is the housing ministry through local media as well in China, pledging those further efforts to try and stabilise the property equity markets as well. Let's get more from our China economy and government editor, Alan Wong, this morning. Alan, what do you make of the statements that we had over the weekend when you stack up as well against the economic data that we not only again had over the weekend on Friday and what we're expecting this morning?
Yeah, so what the housing ministry said was not a big surprise. It was just a continuation or a confirmation of what the Chinese leader said last week about supporting the housing sector. But it's a confirmation that people might look forward to because there was belief that the China stimulus measures in September was one-off, but all this stream of confirmations just signal that there's more to come. Although you might say that investors are disappointed by the lack of specifics, as we saw on Friday and last week in general.
Right. And how do they manage expectations, you think, around a currency that really should be moving weaker and a bond market that should be rallying even further? Have you heard anything from the PBOC along those two lines?
They've only given very broad statements, but they signal that they will manage expectations, though they will do that somehow. They will communicate that somehow. I think economists have a consensus over what China needs to do to maintain the stability of its exports and to prepare for Trump's return to the White House.
So what do you think then is the key metric going into today? Because we've had those vows to boost consumption. We've had it for the property sector. What is going to be most important, do you think?
So from data dump, I think one key metric to look for is retail sales, because from the Central Economic Work Conference last week, we heard the Chinese leaders say that they want to vigorously boost consumption, which is something that's relatively new compared to the stimulus announcements in the last 2 months. So if retail sales figures kept growing at a fast pace, that might be seen as a signal that previous measures had done enough. But if retail sales fall again after the bump that we saw in October, then policymakers might have more reason to increase the extent and the scope of their stimulus measures.
Alan, thank you so much. Alan Wong there, our China economy and government editor, just getting us warmed up here ahead of some key numbers coming through. Home prices in 23 minutes, and in 53 minutes, of course, the activity numbers coming through out of the National Bureau of Statistics. Let's have a look at the market implications and overlay of this. Joining us out of our Shanghai, well, in Shanghai is Shenyi, CEO of Shanghai Shenyi Investment. Shenyi, good morning, and a pleasure to have you on the show. I think last time we spoke was right after, a few days after that major policy pivot where markets were rallying 15% over 2 or 3 days. Certainly gone were those days, but I want to get your sense right now of how would you describe market sentiment at this point in time? Let's start with that.
I think people are still waiting. That's the first part. Second, I would say ordinary investors are slightly disappointed. I think the most major institutions are still hopeful. But in my personal view, probably people should be more optimistic about the prospect of financial stimulus going forward. But at the same time, what we would like to see is a clear picture of how this stimulus is going to be, which sector is going to apply to. I think before the end of this year, people probably stay put and the market will stay range bound.
So the market's likely, as you say, to not move largely in either direction or have big swings over the next few weeks, perhaps. Are you saying that being patient for further clarity, we need to wait until the MPC, or do you think that we get more details earlier in the year?
Let me express my view a bit. Probably slightly different from most of the economists that you have heard from. By training, I'm not an economist, but there's several parts. I think people worry lies in two directions. One is people worry about the real estate market. Second, people worry about the local government debt. Both issues, I think, are not too difficult to resolve. First, the real estate, people can easily buy it. The government can buy it as the basically low renting units to supply to ordinary citizens. That problem will go away easily, I would say, by end of next year. Local government debt, the number people talking about is 6 trillion. I think let's make a big number, 10 trillion. Even it's 10 trillion. I think it's relatively easy for government to issue probably long debt to at the rate somewhere at this moment is about 1.8% annualized. So at this rate, the government can issue 30-year bond as much as they want. You can look at example of the U.S. and look at the example of Europe. That problem will go away. So I don't think we have a crisis here or we have a recession here. The issue, I believe, is to find the new growth, where the economy go, how we get the growth we want. I hear the previous guests were talking about retail sales. If you only look at retail sales, I think a little bit short term. But if you look at the bank, bank deposit is growing at a very rapid pace. But at the same time, the retail sales stay put. Why? I think the stimulus can go into a lot of social benefits, protections, medical benefits to get people worry-free about their future. And then they will start to spend instead of giving people a coupon on home electronics or consumption. I will see the stimulus could be better spent on the infrastructure changes, the social infrastructure changes. But that's my personal view. It's a little bit long term. I'm hopeful it will come up very soon. In the next 5-6 months, we'll see some direction from the government.
The issue there, and not that I disagree with you when you look at those two things, like the local government issue and the housing market, because those seem, I guess, what you're alluding to is, that's simply a function of money, effectively, right? Like the government has enough fiscal space to be able to address those two things. What the market is trying to figure out is once those two things, to your point, at best, if those two things are resolved by this time next year, does that automatically mean that consumer confidence comes back? I need to make that mental jump between the two and really consumer spending. Can we have confidence that consumer confidence comes back this time next year as well?
Yeah, I agree with you. If we need to boost the consumer confidence, we need to do more. But the more does not mean more money. I think the more is more reform on the social infrastructure, as I said. If the stimulus will go into social benefit, particularly on the medical side, to waive people of the burden of the medical expense. For instance, there is a number, but you're probably not going to quote me on it. I saw a research report talking about 50% of ordinary people's saving went into the last 30 days of medical expense. That's horrible. I think we should have a medical coverage. We should have more medical benefit for ordinary people. That should help people to spend, help people to boost their consumer confidence. You can see there's a record number of bank deposit, short-term deposit, but no spending. So we should solve that problem.
What about these new growth drivers? where do you actually see them coming from? Because we've seen, of course, advancements in things like solar panels, for instance, where China has become a world leader, but you're also coming up against concerns from foreign governments about exporting overcapacity. So how to manage that and how to actually find those new growth drivers?
I totally agree with you on these issues, but again, I'm in the minority. There's several parts. I think the foreign government are worrying about low-priced products, for instance, solar panels. In China, at this moment, the commercial competition is furious, is cutthroat. It down to the pennies. They drive the profit margin down to single digit. This is not good for Chinese economy. This is not good for our own production. At the same time, cause a lot of issue between countries. My view is a lot of actually, I would say, government like tax rebates and export rebates should be get rid of to help the Chinese production to raise the price of exporting prices. At the same time, that should ease the concern of our trading partners. For that moment, I would say the solar panel, probably we have enough solar panels for the whole world to consume. The issue is just not to say, I would say, to dump these panels onto the world market, give everybody a breathing space. The other growth part, I would say, will be the high-tech manufacturing. We talk about chips, we talk about high-speed rail, all kinds of interesting stuff. At the same time, I would say China still have a lot of infrastructure growth which could be done. It just has to be spent in the right area. For instance, near Shanghai, we can easily build another high-speed rail. We can build another airport. If you're going to Tibet, we can build another dam, very big dam to hydroelectronics. So it's not an issue.
Shenyi, very quickly, one last question for you. Markets are impatient. Good things will take time, to your point. How do I trade the short term, the market?
I'll position myself as, say, the interest rate will go lower this moment, but it go much higher by end of next year. So there's a lot of space to go. If my hope realize we're going to have the medical benefit, everything comes through, I will look at the sector of biotech and a lot of drug companies, which is at the record low prices at this moment. If any sign their profit margin will improve, I think people should jump in.
Shen, thanks very much for your insights this morning. That was Shenyi, their CEO of Shanghai Shenyi Investment. And still ahead, we're live to Seoul for the latest on President Yoon's impeachment, as his failed martial law gamble gives opposition leader Lee Jae-myung a chance to take the top job. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is The China Show.
Right, welcome back. South Korean markets looking like this. Equity markets have effectively reversed all the gains from the morning, and when you look at the currency, it's also reversed the gains that we've seen coming through since this story effectively began. Let's take it now to Seoul, the main streets of Seoul, with our co-anchor Sherry Yan, just standing by for us. Sherry, markets are underwhelmed and unimpressed by what took place there over the weekend.
I mean, we did see those initial gains, but yeah, David, as you said, it's really not being maintained, right? We have seen the Kospi return to levels to before the martial law declaration, but today investors seem to be a little bit skeptical about what happens to Korea's future, especially given the political wrangling continues. So we heard from the Bank of Korea already over the weekend talking about really stabilizing the markets, about how this situation in the economy is still more challenging than it has been in the past. But they are really pledging to do whatever they can, with government authorities, also financial authorities coming out and vying the same. At the moment, though, it's the political instability that's an issue for South Korea, as we have seen that impeachment, and we're now headed towards a constitutional court.
Yeah, and the Constitutional Court, we know it's got a pretty wide window to approve this decision over the weekend. So how exactly is this going to play out?
So the court has 180 days to make that decision. We have seen in the past that it usually takes about half the time or even less. The question right now is whether justices can actually rule on the motion, because there are 3 vacancies right now. Local media saying that, not surprising, political parties are now seeking to appoint those judges so that decision can be made. If the impeachment bill is upheld, then we will see a presidential election triggered within 60 days. Right now, today, you can see it's a rather relatively calm morning here in Gwanghwamun, Central Seoul. But even so, I can see protesters to my left now gearing up for what they call a press conference. It's Seoul's Women Association. They want to oust President Yoon. His powers have been suspended. But a lot of people here thinking that's not enough, that he needs to be arrested. But behind me, we have seen throughout the past week also President Yoon's supporters coming out wanting to keep him in power. So this is only expected to drag on. And while that happens, of course, we'll be watching the market reaction very closely.
Sherry, keep warm out there. Sherry Young, of course, our Asia trade co-anchor in Seoul, just covering the story from the get-go. Fantastic work there from the team. Really on Sherry's point, and just ahead here on the Korean story, we'll be joined by a guest who effectively thinks that a court will not uphold the impeachment. Haggard joins us to lay out his views for us at those times. So give or take in about 8 minutes from now. Also counting down to the open of trade, and also November home prices out of mainland China. Futures pointing to a slower or even mixed starts going into the Monday session. This is the China Show. Good morning. Right, welcome back. Good morning, and we are entering the latter part of December, and yeah, so activity numbers are coming through. We barely talked about the Fed, cryptocurrencies, and also the crypto aspect going into this week.
Well, cryptos are actually trading near a record high right now, and we do actually have President Trump essentially saying that they're going to be offering support for the sector and also building up sort of a Bitcoin reserve, which would be a very new concept. I mean, look at Bitcoin there. You're above $100,000 per token, and it really does seem like the stage is set for further gains from here, especially if you get that regulation in place. That brings in the institutional demand, and you continue to see possibly the ascent. But some of those plays as well, OSL made to in early trade to the upside. Welcome back. You're watching The China Show. We're counting down to the start of trade here this morning, and we're just a few moments away now from home prices data. We're going to get those figures out for the month of November. Question is whether we continue to see a deceleration in price activity, all ahead, Dave, of course, of the big data dump that's coming up in the next hour. And as we've been saying, you would not believe that this is the last full trading week of the year for a lot of different markets right now.
No, not at all. No, it certainly doesn't feel that way. It's barely mid-morning in the Asia Pacific, and already I'm starting to get sort of signs of fatigue right now, just going through the news flow this morning coming out of the weekend. So there's the China story, there's the Korea story, We haven't even talked about the Fed as much. We had the dot plot coming out this week. And then we haven't even talked about the BOJ, which may give us something. We are opening up on the onshore markets right now, opening up flats. Keep in mind on Friday, of course, both mainland China and Hong Kong markets did see a substantial pullback in price. So expectations. Now, after markets closed on Friday, and here's what's interesting too, right? So we had credit numbers coming through, number one, and just this whole flurry of statements really coming out, whether that's state media or ministries themselves, in the case of the housing market and the stock market, that they will be there to backstop and stabilize these markets as we move into really a week where, you know, again, that pullback, and change the page, please, if we can, that pullback in prices on Friday, indicative of markets really wanting short-term fixes to really what's a longer-term problem, a longer-term challenge for the economy. As you can see, we're now below 20,000 on the Hang Seng Index, given that drop that we had on Friday. Couple of things here. We're looking at property stocks. We should be getting the numbers coming through any time now, if not already, on November home prices, number one. Number two, and speaking of potential tactical opportunities, I say potential, I haven't looked at what happened. Wow, 0.2%. That's actually quite something.
Yeah.
That might actually, I don't have my computer with me, and my producer, Ernest, is about to check this for us. This should be actually the smallest drop in a couple of months, if not this year, on new home prices. Belle,
Yeah, I've got a computer, Dave, so I'm lucky, and I've got a window to Ernest as well. But what we understand is this is the 18th straight month of declines, but it is the best month that we've seen since June 2023.
There we go.
So, I mean, I think we can take that as a positive this morning. And actually used home prices as well. They're still in negative territory, down negative or contraction of 0.35%, but better than the month prior. So maybe we actually are getting some better signs coming through. But anyway, you're still tracking casino and crypto stocks.
Yeah, just very quickly. Breaking news is breaking news right now. There we go. Some green on your screens. So Xinhua reporting that President Xi Jinping will be visiting Macau on the 18th, on the 20th, so it's 16th today, so in 2 days or time. Wednesday, and of course, we're talking about the crypto space, 2 and 3% on the back of crypto and Bitcoin trading at about $105,000 right now. But yeah, you know what? That's going to be a big deal. We'll talk more about this. I think we have to really dissect the story. That drop is out of the ordinary. So things are picking up. Early signs of that. Belle.
Yeah, to your point, I mean, that these are better numbers, basically. Yeah. So maybe some more green shoots possibly coming through in the property sector. That's what, obviously, policymakers want to see with that amount of pledges for support coming through for the sector. But let's shift just briefly to also one of our top stories this morning, and that, of course, is the impeachment of South Korean President Yoon Suk-yeol. Yoon has since been suspended from his duties, with Prime Minister Han Duck-soo stepping in as interim leader until the Constitutional Court rules on the impeachment motion within 180 days. So for more, let's bring in former US diplomat Henry Haggard, who's a non-resident fellow at Rice University's Baker Institute. So thanks very much for joining us this morning, Henry. Of course, the Constitutional Court is not fully staffed right now, so that does sort of complicate the proceedings as well. But what's your expectation around what exactly happens next in Korea?
So I think, thanks, and great to be here. I think it's important for us to step back and just take a moment to appreciate what has happened before we get too concerned about what might happen. And what has happened is the former president, out of a bout of nostalgia for an authoritarian past, made a miscalculation that a move to autocracy would be welcomed by his country and by his people. The Korean people stood up and said that that was not acceptable to them. So I think that so now when we look at where we're going forward, I think the mechanics of what happens next are really just details. I don't see any formula or scenario where he is not, the impeachment is not certified. So again, Korean politics is vibrant, it's vigorous. How they'll manage to get that done, we'll all be watching and waiting. But I think it's important to just underscore how clearly the Korean people, young people especially, stood up, but also the press, the opposition, and just general population said this was not acceptable. So I think how it moves forward from here is just a matter of details.
Henry, David here, just to mention to a line coming through out of Yonhap that the ruling party leader Han Dong-hun has also been is also to step down, and I think the point you're making there is, and the reason I want to ask you this question now is, while it's a foregone conclusion for the president, what does it mean then for the party? Can we make the same conclusion for the party?
So again, that's for the Korean people to decide. But I think that the ruling parties, by not standing up that first Saturday and supporting the impeachment, I think they really did not stand with what most Korean people clearly wanted from. It was clear to most everyone from minutes after the martial law declaration and the annulation of it in the assembly. This was not something that the Korean people were interested in. So I think that for a bit there, the ruling party was trying to game it out to try and find some formula where they could see their way through it, politically speaking. So I think by not coming out on that first Saturday, that's going to really damage them. They did, 12 of them did cross the aisle to certify the motion to impeach this past Saturday. So that's good. That's good for Korea. I think that the ruling party is going to struggle. Presumably there'll be presidential elections coming up. I think that most experts I talk to and people I talk to in Korea see it difficult to imagine that the Conservative Party would be able to field a successful candidate. But I would never count out the dynamism of Korean democracy. So who knows how that will go in the actual election. But at the party itself, I think they're going to struggle. They're already very weak overall with 108 seats out of 300 after really a poor showing in April, due in large part to the huge unpopularity of the now impeached President Yoon. So going forward, I think this is going to be a struggle for the Conservative Party to find their vision. And I hope when they do find that vision, it has zero nostalgia for the authoritarian past that was in the 70s and 80s in South Korea.
So Yoon's impeachment also gives his main political rival, Lee Jae-myung, possibly a chance now to take the top job, but he also faces his own legal challenges. Are those going to be a problem for him at all, do you think?
So again, if you talk to any conservatives or any Koreans, really, they will acknowledge that Lee has had his fair share of legal issues. Most conservatives suggest that he should be jailed, but they've been saying this for years, if not decades. So whether he is able to run or not, again, for Korea and Korean people to figure out if that through their rule of law and their judicial process, again, my view is that he'll likely be able to run, but again, that depends on how the courts rule. But I suspect that he will be the candidate. But even if he is not, it's hard to see the opposition not being in the driver's seat in a potential presidential election.
Henry, thank you so much for taking the time, sir, and speaking with us. Let's talk again soon. Right. I would imagine sooner rather than later. Henry Haggard, they're a non-resident fellow at the Baker Institute out of Rice University. In case you missed it, too, we were just looking at some pictures there, right, the live pictures of party leader Han Dong-hun, who, according to Yonhap, will also be stepping down. So this is I guess in many ways, still a developing story. Now, staying on the South Korean story, so officials are urging tourists to continue to come and visit the country while actively engaging with foreign governments over the safety of travel groups. That's as we were just pointing out, their political tensions continue to simmer following the now impeached president's failed martial law attempt. Johanna, co-anchor, spoke exclusively with the Culture, Tourism and Sports Minister, Yoo In-chon.
So we've been doing well, but this time something like this has happened in the middle of the administration. So in my case, I think that changes in the external environment will take time to be resolved. And internally, it's very important for us to communicate with each other, especially through culture. So in times like this, I think we should play a role in providing some comfort to people abroad, and I'm pushing ahead with my work with that in mind.
We have seen a long history of civil movements in South Korea, protests as well, and maybe a lot of drastic political measures, including several martial law declarations in this country. What do you think it takes when it comes to bringing stability to the government and to society as well? As a culture minister, when you see the trends in South Korean society, is this something that you think about?
I think it is very crucial that any expression can be voiced. That's another form of democracy, where people can come out in the square and talk to each other without being hindered, speaking out at ease. Once this time passes, there will be a time when they can communicate well among each other. Of course, at first there will be a gap, so they may clash, and the voices may become louder because of different opinions. But in the end, they will continue to clash and exchange views with one another, and through this process, they will get to bridge the gap and communicate. Of course, it can be a disadvantage on the one hand, but on the other hand, it is a very strong point that democracy is guaranteed and it's working properly.
Are you having conversations with other countries' government officials? Who are you hearing from?
At first, everyone was very surprised. Now, as time goes by, people seem to feel that social life is proceeding as usual. There are no major changes or cancellations at the moment. If you have plans to travel to Korea, go on a business trip or attend a conference, I would like to tell you that there is no problem if you come as planned.
From all of the government initiatives that you're working on, there have been reports that perhaps some of the regional festivals have been downsized, that a lot of the big works cannot be done anymore. What are you seeing so far?
Right now, there are festivals going on. It's the end of the year and there's also Christmas, so the atmosphere should be a little upbeat. But our political atmosphere is frozen right now, so local governments are staying low-key or scaling down the size of events. However, from my point of view, I'm telling organisers to proceed festivals as planned if possible, but it seems difficult to hold such festivals in full scale in this atmosphere. So the economy is a little bit strained at the moment, so I'm recommending that local governments should not cancel those events and festivals. They should hold such events so that they can provide some comfort to the people's hearts.
Do you expect that, though, to have a lasting impact on the broader economy if people are not going out to celebrate at this very holiday peak season?
I think domestic demand is being affected a little bit, as well as the stock market. But what's really important is the external credibility of Korea, not only in terms of the country's economy, but also in all other areas, such as trust and credibility. If this continues, we may find ourselves in a more difficult situation with investment outflows or declines.
That was Yoon Chon, the South Korean Culture, Tourism and Sports Minister, speaking exclusively with Bloomberg's Sherry Ahn there. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and to our guests during our live programming. Check it out at TV Go. This is Bloomberg.
Wednesday, the Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's a pretty high bar.
All this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Well, some of the financial news that we're tracking this morning, and a PBOC official says, or reportedly said, that China will cut interest rates and the reserve requirement ratio in a timely manner next year. The 21st Century Business Herald quotes the central bank's research director as saying financing conditions for the real economy will also be relaxed. China's credit expansion unexpectedly slowed in November as loan demand faltered. Australia's market watchdog is suing HSBC's local operation for failing to protect customers who lost millions in scams. ASIC says 950 reports of unauthorised transactions resulted in customer losses of $14.6 million in less than 5 years. The watchdog alleges the bank did not have adequate controls and failed to investigate consumer or customer reports in a timely manner. An appeals court has rejected TikTok's bid to delay a US ban set for the day before President Trump is inaugurated. The app and its Chinese owner ByteDance now plan to take their case to the US Supreme Court. They're also hopeful of an intervention from the incoming Trump administration.
Well, yeah, speaking of, let's take a look at this in Chinese social media. And a lot of the users have given U.S. President-elect Donald Trump several nicknames over the years, ranging from capricious to baby. Now, his latest, according to Bloomberg opinion columnist Shuli Ren, is the most interesting, that of nation builder. Shuli joins us right now to explain the moniker that he has been given.
Yeah, so some people in China, there's this school of thought that think that the Trump 2.0 will actually be good to China rather than harming China. The idea is that, the Chinese government, we all know China needs to deepen its economic and social reforms to lift itself out of the middle income trap. Right, but the Chinese government has been quite hesitant to do stuff like a social security reform, the hukou reform, etc. And if we look at the last Trump trade war, starting 2018, what the government did was basically weakening the yuan and doubling down on the industrial policies by giving out cheap bank loans. And this time around, even the government has realized it's not going to work as well. Right, the yuan is already very cheap, and China's industrial overcapacity is a problem worldwide, even for the Chinese government. So now there's this thinking that, the only way for China to buffer itself against the Trump tariff threat is to boost domestic consumption. China has 1 billion people, and more than 1 billion people. The 1 billion people have like $20 trillion of savings. It's a huge market that the government and the world and the overseas businesses can tap onto, right? And then China's consumption is only 40% of the GDP. Japan, Japanese are also very frugal. And in Japan, the private consumption is 55%. China is just way behind on consumption.
I mean, the urgency and the need is certainly there. But it's not exactly great timing either for the Chinese economy, because there's not a lot to make people confident when you're facing a trade war, for instance. Your local economy doesn't look great. So what can Beijing actually do? What are the policies that could have an immediate impact, do you think?
So I think consumption coupons could work, not blank stimulus checks, because the Chinese will just pay back their mortgages instead. Just consumption coupons, say like if you spend 100 yuan, I'll give you another 30 yuan. So far, the government has still been trying to direct people's consumption to industrial products like, refrigerators, TVs, etc. And I think they should take a page out of Hong Kong. Like we remember during the COVID pandemic, Hong Kong basically gave us 20,000 Hong Kong yuan dollars of stimulus consumption coupon. You spend it however, like on food, drinks, restaurants, shopping, whatever. And I think that would be a better way than saying, okay, go buy another fridge, because a lot of people already bought fridge 3 years ago during the COVID era.
What did you do with your consumption coupon? I'm curious.
Generally,
not too much detail here, but just give us a sense of what you did with it.
So like Lynn Crawford was even taking in consumption coupons, so I got a designer bag.
I just said don't go into too much detail. But Belle, what did you do with yours?
I can't remember, but honestly, surely you've just reminded me of probably the only silver lining of COVID in Hong Kong. It was the consumption vouchers. They were good. And I think you're right to your point. We've been discussing that with guests. How many times can you upgrade your white goods? Maybe it does need to be a little bit broader. You just can't get a fridge every 2 years.
No.
All right. Well, Shuli, thanks very much for that. Thanks for answering Dave's question as well. That was our opinion columnist, Shuli Ren, there in Hong Kong. And on the eco front as well, make sure you tune into the T Live. That's our T Live function there, where we've got the economists, reporters, all of our team that's going to be manning the deck when it comes to that data dump that's dropping at the top of the next hour. So more ahead. This is Bloomberg.
Welcome back. It's a big day in Chinese markets, and a lot of pronouncements coming through here out of officials. Vows of stability in housing and also the equity market. Maybe again, early signs of a recovery in the housing market. So we get them on a monthly basis. We get the data from the top 100 developers. Also separately is a data set on the 70 major cities and the actual price of home prices, and that actually showed the slowest decline in about a year and a half or so.
Yeah, so it's still negative, but it's less negative than before. And that is positive. And obviously that's why you're seeing the market reaction today. But really excited now for these numbers that are going to drop at the top of the next hour, because one of the key areas to watch is going to be retail sales and the efforts to try and boost consumption. They are expected actually pretty much across the board. The consensus estimate is that we're going to see an improvement essentially in all of the key areas, even if it's just modest. Our Bloomberg economics team is actually a little bit more negative, but some of the high frequency indicators are telling us maybe there are some little green shoots coming through.
I remember I think it was during the pandemic itself, and it's a reminder of how big of a category this is within retail sales. So car sales, for example, did keep some of the overall figure up. And the reason I bring that up is because the prelim numbers from the industry associations in China did show, I think, about a 20% pickup in overall car sales. So speaking of high-frequency data, that might be something to consider as well.
And actually, if vehicle sales did do better than expected or pretty well in the latest readings, trading volumes as well, to note, they're thin across the board for mainland and Hong Kong markets. So other people are also waiting for these figures that are going to drop. As we said, top of the next hour, we'll be discussing with Citigroup as well. Johanna Chua is joining us. Welcome back to the China Show. Taking a look at the CSI 300 half an hour into the session, and we've seen pretty much we're trading sideways right now, and no surprises. We're just about 30 seconds away from the monthly activity data for November that's going to be dropping. So retail sales, fixed asset investment, industrial output, all these numbers are due half an hour after we just had home prices showing a fall, but a slower pace of decline. So the recovery may be looking a little bit fragile here. But the CSI 300, as we said, pretty much very range-bound, very flat right now. Trading volumes are thinner as well, Dave.
Yeah, just 10 seconds away from those numbers coming through. It just enough time for me to sneak in the statistic on new home prices coming through. The smallest decline month on month going back about a year and a half. So early signs of a recovery there. We have the numbers now coming through. And let me get started with a headline number of retail sales. This is again for November, year and year. The estimate is for 5. The range of forecast is for 4.2 to 7. The actual number coming in at 3%. So that one missed every single estimate out there. Some others coming through, though, not quite as negative, Belle, compared to estimates here. What else do you have here, Belle?
So there's fixed asset investment as well. That's risen 3.3%, though lower than the estimate of 3.5%. Industrial output, that's pretty much come in line with expectations. But I think if there's one key line that stands out to us this morning is retail sales, especially after you had policymakers vowing to boost consumption, especially after you've seen these things like trade-in policies, for instance, for people to cash for clunkers, essentially be able to try and reinvigorate spending in the economy. It does seem like well, obviously it hasn't met what economists are expecting there.
Yeah, let's get instant reaction right now. And joining us here on set is Johanna Chua out of Citi. She's head, of course, of emerging market economics. At the back, your initial take here.
Yeah, so clearly this data really verifies the fact that the headwinds for consumers are still very, very high, notwithstanding a lot of verbal rhetoric about supporting consumption, which we got from the Politburo meeting and the Central Economic Work Conference. But we really need to see actual consumption stimulus. I mean, what that we have so far this year has been very small. Targeted cash subsidies before the Golden Week or even the consumer trade-in programs. So I really expect going into 2025, which we've already seen the signal, that we should get a larger fiscal stimulus with the composition much more skewed towards consumption. But having said that, it's very challenging because the global headwinds, the uncertainty under Trump really is not going to instill a lot of confidence in people's jobs and income prospects. And as you said, property prices are still declining, notwithstanding, that it's declining less. It's still declining nonetheless, right?
We just were speaking with our Bloomberg opinion columnist, Shirley Wren, who was saying maybe we're at the point now where we need to do a direct consumption, like what we had in Hong Kong during the COVID era, where the government actually gave people cash to spend in whichever way they wanted. Do you think that Beijing is getting closer to that kind of point?
Unfortunately, that is not our baseline assumption, right? Because our view is, I think from Beijing's perspective, 1.4 billion people giving everyone consumer handouts directly. There's a big concern that, if you're not going to target it, a lot of people might still have very high propensity to save, and you might not get a lot of multiplier effect. So our assumption going into 2025 is that we will have larger cash subsidies than what we got, during pre-Golden Week, and it will still be targeted. So probably targeted for the lower income, maybe unemployed, maybe giving subsidies for people who have more than one child, but probably it's still going to be targeted, unfortunately, but just larger than it used to be.
What do you think the budget deficit target's going to be? Because a lot of debate around that number.
Yeah, so our assumption is basically that we're going to get an additional 2.5 trillion renminbi additional stimulus on top of what we've already had previously. So the 3% will get larger, depending on really what the breakdown's going to be on central government or local government. So we'll have to see what happens there. But overall, additional 2.5 trillion, and that excludes what has already been announced, which is the 6 trillion local government bond swap, and even any potential bank recap. We think that's separate from this 2.5 trillion figure that we're expecting.
The other figure that is sort of standing out, maybe for a better reason, but industrial output was still at 5.4% growth, so in line with what the survey had said. Do you think that, how are you reading that? And is there sort of any concern that maybe it's also about that front loading ahead of tariffs?
I think it's definitely, I think there's a sign of front loading. We saw that in the October data, in the October trade data out of China. Okay, it weakened a little bit in November, but if you add the 2 months together, it's still relatively decent. And the expectation is, with Trump coming in on January 20th, he could put a tariff on day one, although that's not necessarily our assumption. You would imagine a lot of the front loading will probably be happening already up until maybe around January. So maybe up until Chinese New Year, this is where the front-loading season is. But then the question is, well, what happens thereafter? And I do think even though you get an export front-loading, I think manufacturing investment in China is probably going to slow down. If it's going to be weighed by a lot of trade policy uncertainty, there's more incentive for companies to go out. Especially if consumption is so weak, then domestic profitability will also be impacted.
This recent shift in the monetary policy stance, beyond the actual phrase, like what does that actually mean beyond also just a statement of what they've been doing anyway, of just lowering interest rates?
Well, we think it's an important signal, right? Because we haven't moved to this kind of moderately loose language since 2010. So this is kind of a big shift. Of course, the question is how much, what does it mean in terms of actual policy action? Right now, going into next year, we're, I think, still assuming about, kind of a relatively conservative 50 basis points policy rate cut and then 100 basis points triple R cut. But we also said in our note following this signal that it would, we would not preclude the possibility that actually they could actually move to zero rate, pretty soon. I mean, we're kind of indefinite about the timetable. But eventually we can move there if the deflationary pressures are really going to persist, which it seems like it's the case given the data. And we think looser monetary policy has to accompany a more proactive fiscal policy at this juncture.
Would that, and how markets are trying to figure out how to trade this, is there an implicit message there, you think, that the PBOC will not stand in the way of the CGB rally, for example?
Well, it's already happening, right? I mean, in the past, remember when they have introduced this kind of new policy toolkit of open market operation, everyone thought, maybe they're going to do QE. But actually, they were kind of leaning against the wind of long end yields rallying. But now, and recently, I mean, actually, it seems like they seem a little bit more accommodating of having long end yields rally. You've got 10-year CGB rallying very dramatically. And you've seen also a little bit of their open market operation, expanding the balance sheet. So I think there's really been a shift in mindset now at PBOC where I think they're going to accommodate more liquidity support and maybe will not fight as hard in terms of the rally on CGB yields. Having said that, it has moved very quickly, but I still think the bias, because our view going into next year is the kind of slower growth, kind of Japanification, deflationary expectation is going to persist, that maybe this is a trend that's going to persist going into next year.
I mean, the PBOC might change its perception, but it's certainly going to take a lot more to shift the perception of corporates and of households. And we had the credit data, for instance, on Friday talking about, I mean, well, that's it there. You've got new loan growth that's down for a 13th straight month. What did you make of that?
But that's the whole point, right? Actually, for policy, the job really has to come from fiscal policy. Like monetary policy is really just there to facilitate. But in the end, what we see is there's a lot of liquidity in China. Cost of funding is down. It's just that no one has any appetite to borrow. And people's expectation about expected return of investment has come down so much because of this kind of deflationary expectation. So the government really needs to come in and really create aggregate demand, either to more larger fiscal transfers, larger fiscal support. And I think it needs to shift now from, the last couple of years when it's all about the new productive forces, supply side kind of fiscal policies. I think now they get the message and we're going to get more demand side support. My worry is that this has been going on for a while now, that the scale you need to kind of lift people up is going to be quite large in the backdrop where you have a lot of still external shocks happening with obviously uncertainty under Trump. Not to mention that, housing is an important part of instilling household confidence. And our view is that in 2025, housing prices won't bottom yet. I mean, it will probably still continue to fall, maybe at a decelerating pace. And the reason why we're not confident it's going to bottom yet is even though there's been a lot of relaxation of demand restrictions, they haven't really moved significantly on the excess supply. And that's been taking so long. So which is why I think the equilibrium level is really not going to clear yet next year. So it's a big headwind for people's confidence. You better have a big fiscal support. And our worry and our baseline is even though it's bigger than what we've had before, it may not really be enough. And that's why our view is growth is going to slow down next year.
What's the best case next year?
In terms of stimulus or growth?
The China story, growth, inflation.
We think China is going to still target 5%, right? So at the moment, we are, kind of below consensus forecasting 4.2. Again, maybe they're going to do a little bit more additional stimulus, just like what we've seen this year to catch up to 5%. But I think it's going to be a bit of a struggle. And maybe the best case scenario is, maybe we get a resolution of trade policy uncertainty earlier. If we kind of hope that Trump is really all about negotiation, and that there's been a lot of bark, but maybe the bite won't be so quick, as it won't be as serious. And a quicker resolution can instill a little bit more buy-in and confidence. But of course, the risk is this drags on quite longer because the ability to negotiate and come out with some resolution of this tariff escalation is probably a lot more complicated between U.S. and China than with other allied partners of the U.S.
How do we read then state media? How do you read all these positive commentary, for instance, that comes out when it seems like you're pretty bearish?
Well, look, I think state media obviously has a message they want to portray. It's not like you want to amplify the doomsday kind of message, It's all about kind of boosting confidence and showing the government's commitment to kind of support the economy and support, property or equity market. But the proof is in the pudding. And I think there's been a big pivot in policy from a signaling for sure. And now it's really just about delivery and implementation. And I think that's really the question that we have to watch.
All right, Johanna, stay with us because there's a lot of things to get through in the next block. That's Johanna Chua there from Citigroup Global Markets, sticking with us as we go back to Seoul, actually, in the next break after the ad break as well for the latest on the fallout following President Yoon's impeachment. We'll have more details ahead. This is Bloomberg.
The journey towards the future, which I have walked with many people over the last 2.5 years, must never come to a halt. I will never give up. Holding in my heart all the criticism, encouragement, and support directed at me, I will do my best for my country until the very last moment.
And that was the South Korean President Yoon Suk-yeol just vowing not to give up after lawmakers have moved to impeach him. Now, between developments on the weekend and him actually leaving office, there is, of course, it now goes to the court, which now needs to decide on that. And they do have, of course, a fair amount of time to be able to look into that. But in the meantime, you are getting some promises coming through out of financial officials that if this market needs money, the money's going to be there to stabilize any sort of gyrations we see in these markets. We opened substantially higher than the current levels. We've given up, as you can see, most of those gains, and the Korean currency is actually now trading, has now given up all of the strength coming through since this story began. Let's bring it now to Seoul. Sherry An, our co-anchor, is with us right now to talk us through this. Sherry, I think not sure if you can hear me. Yeah, I think you can. I'll just take a punt here. Markets were initially, I wouldn't say jubilant, but we did see some gains in the opening, but that's petered out quite quickly. Just what's the context here?
A lot of skepticism about the way forward for South Korea, right? I mean, we are seeing still levels to before the martial law declaration, at least when it comes to Korean stocks. The Korean won is still under pressure, but really nowhere close to that 2009 level that it hit right after the martial law declaration. But I guess investors still cautious about what the future holds for this country because political wrangling continues. In the meantime, we have seen financial authorities here in South Korea being pretty proactive. Just over the weekend as well, we heard from the Bank of Korea coming out with a statement pledging to stabilize the economy, that they would support the economy. Also, financial authorities, the Korea Exchange has come out this morning as well, talking about monitoring the financial markets 24 hours. Still, the skepticism seems to be about the longer-term implications of the ongoing infighting, right? I mean, we just heard that the ruling party leader, Han Dong-hoon, has stepped down, apologizing to Korean citizens about the suffering caused by the martial law declaration, but that he still believes that impeachment was the way. But it's a fractured political environment right now, and that is expected to play out as we see this impeachment bill now going to the Constitutional Court.
And actually, Sherry, just on that point, we've got some lines that are dropping here that the Constitutional Court has already begun reviewing the impeachment. We've been speaking with a Constitutional Court official by phone. The court is not fully staffed, though, as well. So just talk to us about the process ahead and how protracted this could or could not end up being.
Coming into this process, there were a lot of questions whether the Constitutional Court could actually rule at this impeachment motion at all, because there are only 6 justices right now in the bench, and there are 3 vacancies. We heard this morning from local media that political parties are now seeking to fill in those vacancies. But in the meantime, in order for the impeachment bill to go through, the Constitutional Court has to uphold it, and then it has 180 days to do so. In the past, we have seen them come out with a ruling in half the time of that or even less than that. And then after that, if the impeachment motion is upheld, then you would go to the presidential elections within 60 days. In the meantime, of course, South Koreans are just divided. There is a lack of confidence in the political system right now. Behind me, you can actually still hear protesters gathering, demanding that President Yoon be arrested. They're a women's association here in Seoul, and I spoke to them. They're telling me that the anti-feminist agenda by President Yoon cannot continue into the next administration. They weren't that confident that just a change in the administration would achieve that, but they want to see change in society. So we're seeing big emotions here across society here in South Korea. So that is a concern for investors, also for economists, of how much that could dampen the South Korean economy, especially as we have an incoming Trump administration and potentially even higher tariffs.
All right, Sherry, I hope you can get somewhere warm now for the next couple of hours. That was our Bloomberg Asia co-anchor, Sherry An, there in Seoul. And let's bring back Johanna Chua, head of emerging market economics at Citigroup Global Markets. And we've heard from the BOK a couple of times over the past few weeks, pledging this stability. What do you think about the political process that we've seen, and does that at all complicate the outlook for the bank as well?
Well, to be frank, the impeachment going through successfully on the 14th was actually in line with our expectation. In a way, at least we're making progress. It would have been worse if this kept failing in terms of an attempt, and then the president was still refusing to resign, then you end up having a protracted standoff. So at least there is movement after all the heightened uncertainty, and that should provide a little bit of relief, as we've seen a little bit in the market. But you're absolutely right. As you mentioned, we still have 3 vacancies we need to fill in the Constitutional Court. Court, our working assumption is that they'll be able to fill that by the end of the year because there's already been some announcement that they want to fill those posts. So if they fill that by the end of the year, they can start reviewing and start making progress on a decision by the start of next year. And look, I think the good thing is you have institutions in Korea that work, that we have a track record. Yeah. The last time we had a 2016-17 impeachment process, that took 91 days. If you go back even earlier, in 2004, the decision of the Constitutional Court on looking at the impeachment case took about 63 days. So you can see we have a playbook of between, say, 63 to 91 days. Our assumption is if they can review it by maybe beginning of the year next year, you can actually get a final Constitutional Court decision which will validate the impeachment. Our assumption is maybe around middle of March, in which case then you can have an election by middle of May. So again, it's taking a little bit longer. It's unfortunate, the timing, because obviously U.S. Uncertainty with Trump coming in. You already have the economy slowing down. We are expecting there will be a supplementary budget that will pass regardless. But again, it's a question of the size and the timing. I think the economy is already clearly slowing down, but at least we're getting movement. And I think the institutions will be able to kind of work its way through the process, notwithstanding kind of the negative sentiment at the moment.
Does it remain just a liquidity question for the BOK, for example? In other words, does it spill over and become a policy consideration?
No, look, I think this is definitely could have an impact on confidence, which can spill over to domestic activity at a time when you look at Korea's inflation. It's already kind of headed below the target. So actually, if anything, what we've seen in Korea with the surprise cut earlier is that really they're now shifting their bias, where in the past, for example, when you have FX volatility, like in 22, 2023, it was kind of a deterrence to kind of, it kind of caused them to be a little bit more hawkish. But actually this time around, FX volatility, I don't think central bank is really, BOK is going to have the same reaction function because of where we are in the economic cycle, with output gap turning even more negative, with inflation below the target. So they're not really as perturbed anymore about FX. And at the same time, in the past, when they were a little bit hawkish, it had something to do with financial stability and housing prices and kind of, household debt. But now I think in this environment, financial stability has been less of a concern. So now they can focus on growth. And so therefore, I think the policy bias is, again, they will try to manage to provide ample liquidity, and they have a lot of potential policy tools. They've also been using kind of, NPS, kind of FX swap to help stabilize the FX. But I do see them continuing, with the kind of the gradual rate easing cycle. In fact, if anything, because of the weakness in data, we actually move forward a little bit more aggressive rate cut. So we have a 100 basis points rate cut next year.
So in Asia this week, we've got Indonesia, Thailand, Philippines, Japan, and then you can add to that, of course, the Fed.
And Taiwan.
Oh, and Taiwan. Yeah, so
there we go.
We have LPR decision in China as well.
Okay.
So very active.
What else do we have?
I want to know which...
Pakistan also.
Oh, gosh, okay. You really read up, Johanna. You really know your stuff. Which one do you think has the greatest capacity to surprise us this week?
Surprise us. I mean, look, again, right now, pretty much a lot of our calls is actually in line with consensus at this point. So, for example, among all the central banks you mentioned, obviously the Fed, everyone's already expecting 25 basis points cut. That's pretty much baked in. We have Philippines, we're expecting also a 25 basis points cut. I think that's also in line with consensus. But for the other central banks, we have them pretty much on hold. Again, Thailand, Taiwan. I mean, Thailand, they're always kind of resistant despite kind of the political pressure for them to ease. I think they're looking at the growth metrics, it's not so bad. But yeah, look, I think the focus is really going to be on the language and what is the signal. So everyone's going to be looking to, is Powell going to signal, maybe less, before he already said less urgency to, aggressively cut, but, could there be signaling of a kind of a pause on the horizon? So these are things that people are going to look at, like messaging. But in terms of surprise, again, I'm not really expecting any major surprises. As I said, our calls are pretty much consensus.
What's your expectation around the dollar next year, broadly?
So, our view is really, obviously the dollar already had a rally in the run-up to kind of the Trump victory, and then it's kind of stalled a little bit, and then it had another rally. So our view right now is the dollar will probably still stay quite bid in the beginning of the year. So we're not of the view, some people say, the Trump tariff threat's already there. It's already fully priced in. Actually, we don't really think that that's the case, because right now, actually, Trump has been relatively restrained in some of his rhetoric against China, actually. Interestingly enough, he's been more aggressive on, say, Canada and Mexico, allied countries than China. And my fear really going into next year is his strategy is to escalate, to de-escalate. So it's kind of, my fear is really it's kind of calm before the storm, kind of positioning himself. And then even though I don't expect him to kind of fully blown, across the board big tariff on China, which obviously would have a blowback effects, I'm really worried more about the threats and the rhetoric of the threat. And that could still create another round of dollar buying as well.
Have a great holiday, and we'll speak to you in the new year. Fantastic there, and I hope you're right. It probably is. Of course, Johanna Chua there, head of emerging market economics at Citigroup. Global markets, plenty more ahead. A full market roundup as we head into the Japanese lunch break. We didn't even get to talk about the BOJ. We can do that next time. This is Bloomberg.
Wednesday, the Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's pretty high bar.
All this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Taking a look at some of the movers this morning, and there's actually been a couple of different Morgan Stanley outlooks that are in play, essentially, because we're seeing some gains here across the board. TSMC and Alchip, these are being have had their price targets hiked by Morgan Stanley. They're looking to greater AI application-specific integrated circuit advanced packaging revenue that is expected for next year and also 2026. So that's something you're seeing here as a positive. Also, you've got Cathay Pacific and Fubon. They've also had their price targets raised on stronger earnings outlook. So that's there. But consumer stocks, of course, we're tracking those this morning, Dave.
Yeah, after retail sales coming in below even the lowest estimates out there, as you can see, markets are selling off some of these consumer names. And unsurprisingly so, the one that is really gaining further traction right now is the CGB rally. And the 10-year yield is down a further 5 basis points today at 173. Plenty more ahead. This is Bloomberg.
It's 11:29 a.m. in Tokyo this morning. Japanese markets are just about to go on their lunch break. Big week really ahead because we've got a lot of different central bank decisions. One of those is the BOJ. There's a possibility that they could hike rates. Of course, we've got the Fed in play as well. And then in the region, it's also how traders are sort of reacting to China's economic data and what that's signaling. And unfortunately, it tells us that there's still more work to do, essentially.
Yeah, it's early days in the recovery. The bond market is really telling you the story that the data, to your point, has confirmed for us in the retail sales number. Asia Pacific, we're down about a 1%. Here's a look across different sectors. Really, the story, as Belle was pointing out, is we have a lot of It doesn't feel like we're entering the Christmas and the holidays here, given how busy it is on central banks. And also separately, so we know what the central bank calendar looks like. It's also quite important on how different the macro conversation can be by the end of this week. What's the dot plot going to show? How open will Jay Powell describe the January meeting, or is he going to simply keep that door open and let the dots speak for themselves? All things considered, we're seeing money being taken off the table. Although S&P futures, as you can see, are still higher here, 61.32. Right, just to recap the numbers that we've just alluded to there. So a miss on the retail sales print, a big miss on retail sales. We've come in line with expectations, though, on some.
Yeah, so we came in line with expectations on industrial output. That was sort of the key one. Fixed asset investments, so a little bit below the consensus reading. Property prices as well, or new home prices, that was also something to track, because actually that came out half an hour ahead of this activity dump, and at that point we were pretty optimistic about what it was going to signal.
We needed to rip up the script for about 5 or 10 seconds or so there.
Exactly, because prices, they did fall, but they fell at a slower pace in what is being, of course, called a fragile recovery. But let's get the reaction from our Bloomberg intelligence team, bring in our real estate analyst Chrissy Hung. And what did you make of it? I mean, it's still negative, but maybe less negative?
Yeah, so November data, we are seeing an increase in the number of cities showing higher home prices, which is a good sign. But if you look at developers' November contracted sales, I think that is already painting a picture of a slowdown. So we maintain our view that the wave of stimulus measures from September could be producing a short-lived recovery instead of a sustainable one. And I think that suggests the need for more policy support going into 2025.
What types of cities are doing better than others?
So in general, Tier 1 and also some of the bigger Tier 2 cities are more resilient, and we continue to maintain that view that they would be the first one to find a recovery. Whereas, in low-tier cities, we are still seeing, very heavy oversupply, and that coupled with the employment situation, we are still quite pessimistic going into 2025 for the smaller markets in China.
We are seeing, though, or have that expectation, we've had the shift from on the monetary policy front. So is that going to sort of help the market at all, or sentiment?
Yeah, so I think the market is certainly hoping that with potentially bigger fiscal spending going into 2025, that might give the government more headroom when it comes to purchases of unsold homes from developers, and also ensuring the completion of unfinished homes to try and help revive confidence from the home buyer perspective. But that being said, I've highlighted many times that the housing market in China is facing persistent structural challenges. I think the government would need to come up with more creative solutions to address those problems. And in the traditional demand-side stimulus front, we are really running out of ammunition to stimulate the market. Mortgage rate, demand, down payment ratios, they're already at record low. And most of the cities have already relaxed home purchase restrictions. So that gives you very limited room to ease further going into 2025.
If you could isolate one or two of the structural issues that this market faces, what would they be going into next year? And what would be a possible solution?
Yeah, so I think going into 2025, we're still expecting a drop in new home sales volume as well as prices. And with the structural challenges, I think one of them would, be rooted in confidence. How do we turn around confidence when it comes to people believing that private developers would be able to complete pre-sold homes, as well as we need to shift or re-anchor expectation from households. Because if you look at the new set of new home price data, yes, we are seeing some marginal improvement, but 60 out of 70 cities, they're still showing decreases in home prices. So for the second-hand market. So I think that as long as people think that home prices are going to go down, they would stay on the sideline and defer their home purchases. So those are the key factors. And I think going to 2025, we also need to look at solvency for developers like Vanke. If they are going to encounter any more liquidity crisis, that's going to deal another blow to sentiment.
Yeah, I was going to get to that. What do you think default rates will look like next year? And also separately, earnings too. That could be something different from what industry prices are showing.
Yeah, so when it comes to earnings, state-owned developers, they tend to have stronger pipelines, and we're still seeing more resilient earnings coming from them. Private developers, they're really suffering. Supply pipeline is becoming more limited, and I think we shall see, questions for the solvency going to 2025 if new home sales, which in November is already posting year-on-year decline, is going to further deteriorate in 2025. And with our drought in debt sales, equity sales, some of these developers could really come into liquidity trouble next year.
All right, that was our Bloomberg Intelligence real estate analyst, Christy Hung there. And of course, really the standout so far today has been the retail sales. And I think just for how disappointing it was, because the expectation was for growth of 5% and it came in at 3%. And there's so many different ways that can be expressed, and so many brands that are feeling the pain of that sort of sentiment.
Yeah, margin compression, we've seen that. I think when you look at the most recent earnings season and the commentary coming through out of, say, the European luxury names, for example, I mean, China was really a pain point for them. And it's hard to see how that doesn't remain the case going into the next earnings season on the back of the retail sales miss coming through. All that being said, right, so the weakness coming through overall, are there bright spots, though, within the sort of luxury and the high price point space? And you do, from the commentary coming through out of some of the key economic meetings that we've had this month so far, officials are still planning to backstop growth, stimulate demand. Consumption does remain their top priority going into next year. And that certainly will be, to the point we were just making there, welcome news for many of these luxury brands who've seen their sales slide and their fortunes fade as shoppers really have tightened their belts. Our China correspondent, Min Min, has filed a special report.
This 5-story Louis Vuitton flagship store in Beijing was supposed to open its doors to shoppers in early 2024. LVMH CEO Bernard Arnault told Bloomberg he was optimistic about the group's growth in its largest market.
I am always optimistic, and the people have often concerns which are not materialized.
But now, sources say the store may not open until as late as next year. The slow progress is symbolic of the challenges European luxury brands face in China. LVMH shares have plummeted since the start of 2024, revealing the scale of the slump in demand from Chinese consumers. Another luxury group, Kering, warned that its annual profit will fall to the lowest level since 2016 due to weak Chinese demand for designer bags and clothes. Prestigious watch brands like Richemont, the group behind Vacheron Constantin and IWC, and Swatch Group, owner of Omega, are also affected. Swatch shares tumbled this year after sales in China, which account for about a third of its revenue, fell sharply.
Many watch manufacturers are really dependent on China, generating 40–50% of their sales.
This pullback in lavish spending is hitting some of the world's richest. LVMH CEO Bernard Arnault's fortune tumbled from the top spot in the Bloomberg Billionaires Index. Founder of Kering, François Pinault, fell out of the global 100 richest. Shoppers in the world's second-largest economy are shying away from excess buying as Beijing grapples with low domestic consumption and a shaky property market. President Xi Jinping's government has rolled out a series of stimulus measures to boost sentiment. Bloomberg Intelligence says China's luxury goods sales and the downturn in the industry may reverse in the second half of 2025 if Beijing continues to roll out economic support. Min Lo, Bloomberg News, Hong Kong.
And that is, of course, as we had retail sales data today for the month of November in that broader activity dump, the real weak spot with growth at 3% when the estimate had been for expansion of 5% in the month of November instead. Right now, we do have an NBS or a National Bureau of Statistics briefing underway. We're hearing from the NBS spokesperson, Fu, right now, really reflecting on what we're seeing in the property market instead. This actually was an improvement, still negative. We are still seeing price declines, but fewer or less price declines than months past. And he's saying that China will speed up the property market's new development mode, that expectations have improved, and it's moving to a period of stabilization right now. Property stocks, we actually had seen those moving higher off the data, and we will be tracking those throughout the session, but we'll have plenty more ahead. This is Bloomberg.
Fresh fruits and aquatic products reduced among the range of 13.2% to 1.3%, and occupying for
Welcome back. Happy Monday morning. You're watching the China Show. Good news if you're looking for a job in Hong Kong and you're in the wealth management sector. So you have licensed finance jobs in the city have hit a record, as certainly you look at the companies here in the city are ramping up their hiring to cater to all this money coming through from mainland China. Let's bring in our finance reporter, Denise Wee, to talk us through what is driving this pickup in hiring, particularly among the private banks in Hong Kong.
Yeah, David, as you mentioned, there's a return of wealthy Chinese to Hong Kong, mainland money returning here. And that's a trend we saw last year, and it's continued to accelerate this year. Basically, post-border reopening, restrictions removal, mainland Chinese are coming here. The Hong Kong government has been rolling out the red carpet for wealthy Chinese. Yeah. And, with tax concessions for family offices, with various top talent schemes. But at the same time, we've seen Singapore also dealing with the fallout of a major money laundering scandal, which has increased scrutiny on foreign money flows. So as a result of that, we're seeing more money coming back to Hong Kong.
And is that a trend that is expected to continue? Is this the first of more gains to come, or is it sort of a stabilization if you've already had the people that are sort of moving away from Singapore that could be done, for instance?
Well, I think it feels like it's a trend that will continue. Chinese increasingly want to diversify their exposure away from China, where there's been a property crisis. It's been, markets have not done well. So they're looking elsewhere to put their money to play. Hong Kong has been a conduit for that. And in general, they've always wanted to park their money overseas, and it's become harder to put it some other places at the moment. So I think that flow will continue.
And then in terms of specific segments that look to be growing even further?
Well, I think based on the PWME's report, they have mentioned that the 5 to 10 million is around that you'll see, the biggest jump in firms targeting that business. Okay. And we've seen a lot of inflows of, not super wealthy, but fairly wealthy coming to Hong Kong. So that's the rung they see growth. They also see growth in the higher, more like above 100 million, 200 million. So I think it's both sides of the spectrum.
Great. Right. That was our finance reporter there this week.
Yeah, just in case you didn't know who that was.
Oh, dear. And you can get an insider's guide to the money and the people that are shaking up the finance hub in our Hong Kong edition newsletter. That's out every Thursday. You can also sign up via bloomberg.com/newsletters. Let's we'll get to some corporate stories we're tracking this morning, Dave. And Australia's markets watchdog is suing HSBC's local operation for failing to protect customers who lost millions in scams. ASIC says 950 reports of unauthorised transactions resulted in customer losses of $14.6 million in less than 5 years. The watchdog alleges the bank did not have adequate controls and failed to investigate customer reports in a timely manner. An appeals court has rejected TikTok's bid to delay a US ban set for the day before President Trump is inaugurated. The app and its Chinese owner ByteDance now plan to take their case to the US Supreme Court. They're also hopeful of an intervention from the incoming Trump administration, and we'll have plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. We'll take you straight back now to the ongoing briefing out of the National Bureau of Statistics following the release of the activity numbers coming through. The latest line coming through on their guidance around inflation going into the next year. And their expectation is a pickup will remain the case, a small pickup, a small increase in CPI to be more specific. Going into next year. A couple of other things too. So the property market, this was really I think a focus that really came, well, very much in focus here, given the numbers coming through. So the decline we saw month on month across the 70 cities for the month of November coming in at the smallest decrease, at the smallest contraction going back to June of last year. And that they have acknowledged that, according to the NBS, that China will be speeding up this new development mode for the property sector, that they have acknowledged that expectations have improved, moving towards a period of stabilization. Now, it's early days, and to the point that our analyst from Bloomberg Intelligence was making just a few minutes back, in case you missed that, was that there might have been front-loading in October, and that the early signs of the pickup seem to be petering out given some of the high-frequency numbers coming through. They will take more of the structural issues that this property market still faces going into next year. So some of the numbers coming through, in case you missed that too, the retail sales coming in at 3%, expectations for 5% year on year. Industrial production, that one coming in just about in line with expectations. Citi joined us earlier on, Johanna, Chua, and said that might also be a function of front-loading, which we did see, of course, as far as the PMI numbers were concerned. Suffice to say, there has been a pickup, and what really is behind the pickup is another question altogether. Right. We're looking at other things, too. So the Bitcoin is a story that we're tracking, too. In fact, just for Bloomberg clients, right, when you look at a Bitcoin story, CRYP Go is the function on your terminal. And it's not just Bitcoin. I think we track 40-odd cryptocurrencies out there. I could be mistaken. Bell might just correct me on this, too. We're seeing just about gains, and crypto is really strong out of the gates this Monday, and that's really playing out across the equity markets that are related to the asset class here, Bell.
Yeah, actually 58 different crypto assets you can find on CRYP but it does give you the ones that are moving the most liquid, heavily traded different currencies. Why we've seen that as well is because President Trump, or President-elect Trump, of course, very crypto-friendly. Property prices or property names, not seeing too much movement, but essentially we did see some better figures coming through. So home prices still fell in the latest reading, but they fell less than months gone prior, and so that is sort of a signal perhaps there is a little bit of stabilization. Korea is something else that we're tracking this morning, and we've kind of seen, we did see some optimism in the markets. It kind of gave up, and right now it's still sort of steady. I mean, we're tracking really all the latest. We know that the Constitutional Court has started reviewing the weekend vote. We had that second impeachment vote. This time, lawmakers voted to remove President Yoon. But that decision does need to be essentially approved by the Constitutional Court, and that process is now possibly underway, although the court is not fully staffed either. So questions, of course, as to how that plays out. But we've also been speaking with government ministers about what's the outlook for tourism, especially at quite a busy time of the year, I guess.
Yeah, I actually know a few people who've put their trips to Korea on ice because of what's taking place there right now. And I think to your point there, Bill, that they have come out and come out quite strongly that to visitors, please do come. They are urging visitors to continue with their plans while actively engaging with foreign governments over the safety of those travel groups. That's certainly as these, the political tensions simmer. There's still uncertainty over these next few months or so. Sherry An, of course, our co-anchor, our Asia Trade co-anchor, has been covering the story for us, and she actually spoke exclusively with the Culture and Tourism and Sports Minister about this specific issue.
So we've been doing well, but this time something like this has happened in the middle of the administration. So in my case, I think that changes in the external environment will take time to be resolved. And internally, it's very important for us to communicate with each other, especially through culture. So in times like this, I think we should play a role in providing some comfort to people abroad. And I'm pushing ahead with my work with that in mind.
We have seen a long history of civil movements in South Korea, protests as well, and maybe a lot of drastic political measures, including several martial law declarations in this country. What do you think it takes when it comes to bringing stability to the government and to society as well? As a culture minister, when you see the trends in South Korean society, is this something that you think about?
I think it is very crucial that any expression can be voiced. That's another form of democracy, where people can come out in the square and talk to each other without being hindered, speaking out at ease. Once this time passes, there will be a time when they can communicate well among each other. Of course, at first there will be a gap, so they may clash, and the voices may become louder because of different opinions. But in the end, they will continue to clash and exchange views with one another, and through this process, they will get to bridge the gap and communicate. Of course, it can be a disadvantage on the one hand, but on the other hand, it is a very strong point that democracy is guaranteed and it's working properly.
Are you having conversations with other countries' government officials? Who are you hearing from?
At first, everyone was very surprised. Now, as time goes by, people seem to feel that social life is proceeding as usual. There are no major changes or cancellations at the moment. If you have plans to travel to Korea, go on a business trip or attend a conference, I would like to tell you that there is no problem if you come as planned.
From all of the government initiatives that you're working on, there have been reports that perhaps some of the regional festivals have been downsized, that a lot of the big works cannot be done anymore. What are you seeing so far?
Right now, there are festivals going on. It's the end of the year and there's also Christmas, so the atmosphere should be a little upbeat. But our political atmosphere is frozen right now, so local governments are staying low-key or scaling down the size of events. However, from my point of view, I'm telling organisers to proceed festivals as planned if possible, but it seems difficult to hold such festivals in full scale in this atmosphere. So the economy is a little bit strained at the moment, so I'm recommending that local governments should not cancel those events and festivals. They should hold such events so that they can provide some comfort to the people's hearts.
Do you expect that, though, to have a lasting impact on the broader economy? People are not going out to celebrate at this very holiday peak season.
I think domestic demand is being affected a little bit, as well as the stock market. But what's really important is the external credibility of Korea, not only in terms of the country's economy, but also in all other areas, such as trust and credibility. If this continues, we may find ourselves in a more difficult situation with investment outflows or declines.
That was Yoon, the South Korean Culture, Tourism and Sports Minister, speaking exclusively with Bloomberg's Sherry-An. Markets are fairly steady right now. Lots of event risk ahead. That's it for the China Show. This is Bloomberg.